Thank you for joining us. In interesting times, as usual. We often, in fact, Andrew's got a great story of a client who was deciding whether he should sell or not, and luckily decided to sell. And within the next 6 months, I think there was Nenegate, and then Trump was elected for the first round, and I think Brexit happened in the next 6 months. So yes, you never know when there's going to be a curveball. It does mean when you get into deal making, you ought to do it quickly. Andrew, what do you think of the impact of our good friend Trump on markets, on the M&A world, and particularly on our M&A world, which is quite unique?
Absolutely. Afternoon, everyone. Thanks for joining us. I think it's definitely the hottest topic currently. I think like anything, I think the big difference here is, unlike COVID, this was almost a deliberate man-made event. When I say that, triggered massive uncertainty. What's quite interesting was although there were lots of ripples on the listed markets, obviously the inklings of a trade war, it didn't seem to rock the boat in our world. So I think the ability to look globally, to look at alternative markets, is one thing to find a buyer perspective. But I think what it does for, buyers out there is they realize all their eggs are in one basket, or the risk profile of the likes of the US or things like that are fundamentally changing. And that's very interesting. We actually went live on one of our transactions, and the very first person we contacted this morning was based in Belgium, and that they've come back and said they're keen at looking at the target. So it's interesting. I think there's always a challenge. Obviously, this was extreme, but I think there's always a way. There's good buyers out there. The challenge is just finding them. And I think we've learned over the last 5 years, definitely, that there's always waves out there, and you just figure out a way how to navigate them.
Yeah, no, keep our heads down. As I say, the biggest factor, and it's something that we learned about a year ago, to be honest, we really emphasized it, was this factor of time. The deal is happening, you've got to move quickly because you don't know what's coming around the corner. So just bear that in mind. Kind of doesn't matter when you start, but when you enter the trenches, you stay in those trenches, you stay there till you're done, and you get it done quickly. So it's certainly something that we focused on. I think in terms of today's webinar, the topic around recent M&A deals we've done, deals we're busy with, giving it a bit of structure around the things we think are really important and the things that we've had to become better and better at, and then to talk in the context of those. Now, just a couple of those things that we feel critical. One is finding the right buyer, not just any buyer. Just a tenacity. Deals don't close on their own. They're not designed to close. They're designed to fail. So you've got to have a huge amount of tenacity. And on top of that tenacity is this ability to support the deal right to the end. There's a tendency in our world for the advisor to step away. Well, the deal's kind of done. You guys solve it now. You're going to do your legals and DD and get it all done. It doesn't work. It needs help. Deals need help right to the end. So end-to-end is important. In the world of managing succession, and probably more importantly about not letting succession get in the way of a good deal, because good deal structures solve succession problems. And I think that's something, just generally deal structures, I think, are critical and an interesting part. The use of debt in deals, and the fact that almost none of our deals is one particular world where we do land up with debt in deals, but mostly not. The power of choice, I think, is another interesting one. So we're going to, across headings, talk to the real deals that we've got. I think we'll go through a couple of examples and then revise the list of the particular deals we're talking about. Maybe as a quick summary, though, we closed 4 deals last year. We were a bit disappointed because a bunch of them rolled forward into this year. We've closed 3 already this year. We've got another which will close this month, and another, I think, 4 that will close in May. So yeah, we really are having our best ever deal closing period, which is really exciting. It also means we've got a lot of real stuff to talk about. There's no theory in this, rubber hits the road stuff, and hopefully you'll all find it interesting. I do want to emphasize there's a Q&A feature. Please don't hesitate to pop questions in there, even the difficult ones. We'll tackle what we can. And if it's too difficult, we'll tell you. I hope it won't be. So please feel free to pop your questions into the chat. Andrew, just in terms of the critical success factor in our world, finding the right buyer, do you want to just talk through maybe some examples of where that's happening and that's happened in our world?
Yeah, sure, Rick. I think it's one of those things where I'm sure a lot of people on the call have spoken to multiple advisors or professionals in the space, that it seems so obvious, almost commoditized now. But it's so interesting that if you look at a traditional approach, there's typically a handful of buyers, whatever it may be, and a huge focus is on engineering the right transaction. Whereas we've learned over the last 10 or 15 years that if you get the right buyer or the right acquirer, you can sort out that transaction element. And it comes down to what is your definition of right. And I think that's, at the end of the day, the driver around synergies, what you want to do from a growth and exit perspective, an alignment of culture, and someone who's actually got money. And so I think that from that perspective, it's really key. And we see it, we're fortunate that in the majority of the transactions that we've closed recently are in the process of closing, the power of having the right buyer. And when we say that, you'll have one company and multiple people looking at this one company, and how one buyer just sees a whole different level of value. And I've got one real example now that we're hopefully about to go into ComCom, where we had multiple buyers at the table, 3 in fact, and literally on the same day, the one party came in with an offer at around 225 million rand for this business, which was probably a little bit low to what expectation was. And the successful bidder came in at 450 million for the exact same business, both coming out of the same industry. And what played out there was the fact that there was just alignment. They could see the vision, that there was connection between the executive and the shareholders and the acquirer. And it just got an even rarer situation on one of your recent deals, which just proves the power of finding the right buyer.
And those who've chatted to us recently will have heard about a foundry called Primer out in the East Rand. It was a tough one. It's a big international market. They weren't really penetrating that much of the market. They had a very lumpy revenue and lumpy profits. We were getting very little interest out of the local market. But we had built a list which included the whole market, what we thought was the whole market. We had a bit of resistance from our client about approaching this one party. We eventually got to them. We got them to tell us more about them, this crowd in Chile. When they presented their story to us, they had dots all over the world where they were present, but they had almost nothing in Africa, one little dot in Zambia. So that's when we knew there's a good chance they are the right buyer. And that was it. It was a long journey dealing with time zone and language getting in the way of doing a good deal. A phenomenal deal was done. But that was all about finding that one party in the world who was the right buyer for that business. And even when I met the chairman, when the deal closed in September last year, and I met the chairman of the acquirer, the first thing he said to me was, "How did you find us?" So it's just critical. And I think I've actually just been talking to some guys who've just been asking about how we function, how we work. You've got to start every project with a blank piece of paper and think strategically about where you're going to find that right buyer. Another great example, actually, Andrew, is the software business we're closing now. And I was in a meeting yesterday with the acquirer out of the UK. When it's the right acquirer, all problems get solved quite easily. When it's the wrong acquirer, it's hard to solve the problems. They just keep coming at you. And every time there's a problem, acquirer goes into their corner and seller goes into their corner. And you've got to bring them back into the deal. But with a right acquirer, the problems just come up in little puffs, disappear. So there's so much to benefit from finding that right acquirer rather than it just being about the money or about the price.
Don't you think, just a question, if you look at those deals, and I'll play back on this deal I alluded to earlier, that the definition of right buyer and seeing how it plays out, that when you've got the right buyer at the table, there's almost a common objective of making the deal work versus this like win-lose, everyone's keeping their cards close to your chest. Fundamentally, I think that's what we're seeing more and more now, that playbook play out because of that alignment versus that win-lose.
And I think that plays to my next point. I'll put it down as tenacity, but it's a bit more than tenacity. It's really being thorough about how you implement the process and how do you get it to work. Because something that's, if I think back to my early days in doing what we do, the final price was always an arm wrestle, getting to the final deal, getting the uplift. But when you get it right and you get the right buyer, generally you get good offers up front. And when you get good offers up front, it takes away the pressure to move the price. And you can really put your negotiating energy into structure, quality of the deal, risk. Those kind of things can be dealt with in a much better way when you don't have to fight on price. And so that all comes from this tenacity story. Just 2 examples I want to share. One was also, you might have seen in the press, well, that was kept fairly low key, was a company called LK Products, one of the biggest barbecue outdoor cooking brands in the country. And that deal closed about 3 weeks ago. And that was a long journey. It was a really long journey, particularly because there was some accounting we had to deal with in the way that the business was structured beforehand. We had to play out a certain amount of time on that. So we had interested parties, but then we couldn't close. And then we got the right party to the table. But there's a fantastic beauty about doing 100% exit on day one. And because, you're done, you get your money, you sorted. The big downside is it comes with big warranties and a lot of pressure on the seller to really put his money where his mouth is and say, yes, this business is good and the environmental issues have been dealt with and everything else is fine. And therefore, I'm going to sign these warranties. And again, the tenacity you need to make sure that deal works, because first you've got to go through, when it's a 100% deal, your DD is at a much deeper level than when it's a 60%, because I know they've got you involved in the business. It's fine. We're going to be partners, all good. No, it's a 100% deal. That DD is going to go down to every single detail in the business. And not every seller is ready for that. And that's where our support, I think, was absolutely vital there in working every single day. Taryn on our team was fortunately based in Cape Town, able to be close to the seller, close to helping them with every single detail through that process. And the tenacity got us there. But wow, it wasn't easy, because we were dealing with a seller who was just uncomfortable with the level of warranties that were being asked of him, and an acquirer who was determined to look under every single stone to make sure that they weren't taking on too much risk in the deal. Another interesting one, quite a small deal in our world, but still significant, certainly in the business's world. Anyone in the audience who's got relatively small children will know of a brand, a stroller or pram brand. We were on that deal for a number of years because we knew that you couldn't there were certain types of buyers who could never work with those sellers. They were looking for a growth partner. So we couldn't just go and find someone with money. It had to be a lot more, there had to be a lot more quality in it in terms of fit. And eventually we found the right fit. Deal was done. And by all accounts, every conversation I've had with them, the business is going phenomenally well. But the tenacity required to stay in the game, to say, where is the right acquirer for these guys? The guys with what looks like great synergies, we can just see that's not going to work. And if the chemistry isn't there, if the connection isn't there, it isn't going to work. So you just got to keep looking in a case like that. Any
just
other
quickly,
examples?
Yeah, just really quickly, Justin's covered a great question, and your timing is good. Just around, have you ever fired an acquirer because they've been too difficult to deal with?
That's a good question. I've certainly fired clients who were too difficult to deal with.
Yeah. I can comment there. I have. In fact, we've been working with a client along the tenacity theme for the last 5 years. And one of the reasons that it's taken that long is because we had, in fact, 2 acquirers on one deal, so that we moved into exclusivity and due diligence. And something happened in that process where we fired him because they reneged on some of the terms we agreed. And then we moved into the next process with the next acquirer. And they didn't commit capacity and resource to stick to their agreed timelines. So it's been a long drawn out, probably a poster child when we're actually going to market now. In fact, those are the guys I alluded to earlier that we've approached the market and we got interest out of Belgium. But it is a fine line between what do you accept and when you draw that tough decision to part. But on a deal I'm working on currently, I always use the example that the way the completion and due diligence and final negotiation process plays out is a really good insight into how the buyer and the seller are going to work together. So if it's a real nightmare and it's abrasive and all of those things, you think, is this what the day-to-day is going to look like? So it's never easy, but it also comes down to what options do you have? Rick will raise that final point, but are there additional buyers that were interested? What are your circumstances? Do you have to sell all of those elements? But it's not easy. And I know I've had to do it a couple of times and it's not ideal, but it is what it is. Because at the end of the day, it's looking after what should be a great and successful transaction and hopefully a legacy that's the resounding success in time.
And I think, Andrew, you'll admit that when you start seeing the signs of this isn't the right acquirer, you would think that it would be our job to say, oh, come on, let's see if we can make it. Let's keep nurturing it. Maybe we can make it work. I tell you, when the signs are there, they're there. You can't deny them. You've got to call it. Because nothing worse than just dragging these things out. In fact, these guys who were here in our boardroom just now were asking the question about how do you deal with, and they've been through this before, where you sign, you basically accept an offer, and then the terms keep changing. That's a sign that it's a wrong acquirer. Because a good acquirer holds on their terms and keeps the deal intact. There are, without any doubt, dodgy acquirers out there. I call them dodgy, but they come in various forms, who are quite willing to find opportunities. They see a due diligence as an opportunity to find reasons to drop the price. And the moment that's starting to happen, you've got to ask some very serious questions about it. Just want to talk to, I suppose on this sort of issue of end to end, Andrew, I think that deal that's about to go to ComCom is probably the best example of having to manage it through the DD, not just up to DD.
Yeah, it's an interesting one, Rick, because I think there's always a dynamic. I think unlike LK example where you've got a founding shareholder that's exiting 100%, it's really important to separate the individual from the company because it's almost, and transaction, because it's almost two different journeys. And the one thing we can tell everybody that's given up their time this afternoon is things are going to go wrong. And that process, there's lots of speed bumps along the way. And the only way to manage it is to stay close, to be transparent, and make sure we're all keeping our eye on the ball. And it's been hectic. But what is really interesting is every milestone that you achieve and you get closer and closer almost adds pressure to, is this deal going to conclude? And is there something else? And I think only through very, I'm going to say, close relationships with all stakeholders can you start understanding what the real issues are. And then what's critical is it's one thing, obviously, having the tenacity and the grit to power through, but it's to deal with issues quickly. Opened up with that, Rick. The biggest risk is time and fatigue. And it's so important to manage expectations on both sides and also give proper insights. Because at most entrepreneurs, those of you that are on the call, you will struggle to put yourself in the acquirer's shoes that's got a very framework-driven acquisition strategy and all these boxes and investment committees. It just doesn't necessarily make sense. And the ability to weather those together. But it's long, hard, and it is literally one of those things where you got to pull it up the mountain. But it works. And I think you can't shortcut it. And there is a place for an advisor in that role, because most of the time it does require intervention, a little bit of therapy late at night, and alignment.
You've certainly done a lot of that. I just want to respond to Edwin's question. He's asking to what extent our national political climate affects international buyers' perception of a good business or a good deal. He's asking the question, is it a case of good deal but bad environment? It's very interesting, this, because we've got two big deals, significant deals closing with international acquirers at the moment. And I was sitting on one of the deal discussions yesterday. And I think firstly, what we found in that when we took it's a software business, when we took it to market, you think that it's just, I've got a software business, it's in South Africa, yeah, kind of who's interested. Funny enough, South Africans are all over the world. So we actually haven't got a bad reputation. We might have our local issues, but in so many of the cases where we had meetings, we had 15 meetings on that project, and I think 11 or 12 of them were international meetings. There was always some knowledge of South Africa. So you're right, if it's someone sitting in Wisconsin, they've never traveled out of the US, and they've just heard of South Africa from Trump's last outburst, it's very unlikely that guy's going to even open our email. But you'd be amazed at how many people have got some form of connection to the country, or have got an employee who's in their software development team who's from South Africa, or they've got some investment through here. So I think that's the point, is that the pool of acquirers who are comfortable with South Africa is big enough to be able to do international deals. Even in fact, that Emmy Lekmet who acquired Primer, Eduardo, the CEO, he had worked for Anglo many years ago, but he had come to Joburg a couple of times, and he's in Chile, so he gets more of the developing world. So this is what it is about finding the right buyer. You've got to look to find those guys. They don't advertise. They don't say, oh, we're looking in South Africa. That doesn't necessarily happen. Sometimes happens, not necessarily. You've got to go and look, and you'll find that the right guys pop up. So yes, we have our political turmoil. The fact that the guy in Belgium is interested in looking at a business here as of today, so just after a lot of the drama, just shows that we can often be our worst salesman. Once keep an open mind, because we have unbelievably good businesses. We are a cheap manufacturing environment, and we have brilliant skills environment from an engineering and software perspective. So there are a lot of very good strengths here. And generally we get past the negative issues. We've got so many deals happening with international acquirers. In our last 20 deals, a third of them have been to international buyers. So we get around it, and you'd just be amazed at how much real knowledge of South Africa does exist, and the fact that the positives seem to outweigh the negatives.
I think just on that very quickly, what's also happened over the last couple of years is the risk profile has changed globally. And I remember, trying to do a deal in 2016 when the outlook was particularly bleak in South Africa, and there was this huge gap, this perceived gap in the risk, but that has closed. And I think there has been a realization, more and more buyers, that you got to look for good companies in the right environment. And it's also how you approach them. So you can't be short-sighted. Any potential buyer into that there aren't challenges. We know what the common challenges are. There's poor perception around empowerment. There used to be issues on power, which we've hopefully resolved. And there's, if it's relevant, competition commission issues or the regulatory environment and those things. So it's also how you go front foot on those elements. It's very surprising. That's, I think, a great opportunity for South African companies, because buyers that traditionally looked in one or two markets are now looking in from a broader perspective.
Andrew, I'm just going to go back. We've got a couple of other questions we can come to, but I just want to get on track a little bit around this issue of succession and deal structures. And I don't know if you've got any particular examples. I know one or two. Just the power of the process delivers good deals.
So succession is, I suppose, a question that is on pretty much every business owner's mind. And if you go back to basics, if you have to continuously run your own business, are you building a business or are you self-employed? And I think there's always this pressure on business owners or founders to have a plan in place before they exit. But in most cases, it's really difficult for you to find a successful successor, because generally that person's probably got their own business or whatever it is. And we go back to this common theme. We keep saying, by finding the right partner and having the right deal structure, that can be solved as part of the process. And so if we look at it, I've got 2 deals now where it's not 100% acquisition. It will become 100% acquisition, but there's a transition phase. And in this one particular case, the one that's going to Competition Commission in the next week or two, is there is a CEO in place, but there isn't an executive in place. And when you say an executive, there's a broader set of senior people that need to be brought in. So there's always a case where it has to be a little bit different. But that's why it's truly understanding what is the exit criteria, what is required. And when you do have a succession in place and a team that can operate on its own or mainly on its own, it will change the profile of the type of buyer you need. Because if you don't have anything, typically your private equity players would come in and assist with building that team. If you've got the full team in place, it'll either attract maybe an international private equity player or an industry player. So just to give everybody comfort that, yes, it's a real issue, but it doesn't have to be solved before you go to market.
Yeah. Just another interesting example is a business we sold last year. It's called TerraCore. Classic business. We all wanted this business. We all missed the opportunity. They only manufactured broadly, that we insulted about said this, they only manufacture one product, and that is trays for storing the rock samples from a sort of mining exploration environment. So they manufacture what's called a core tray. Anyway, the 3 shareholders really wanted out. They wanted to exit completely. But the right deal came up, and they had offers which involved exiting completely, 100%. In fact, at the same price even. But the right acquirer said, no, stay in the game with us. Keep 24% between the 3 of you. They brought in some industry experts into their sort of equity side of the deal. The guys have now sold the business. They made really good cash out of it. But now they're living in Cape Town. The business is up in Joburg. They're on the board, but they're not operational. And they've got the upside of a great business that they can still influence through their shareholding and through their directorships. The best structure isn't always what you thought was the best structure. Structures and deals create themselves on the way, and you've got to keep a fairly open mind around that. Just another interesting thing about these kind of deal structures is flows forward to the issue of debt. And let's be honest, we don't like debt in deals. Most owners don't like debt in deals, put that way. M&A people love debt because it means you can structure more, you get all clever with return on equity. But most deals, we don't see any debt. And I think if we go through last year's deals, we had Nula, no debt. TerraCore did have debt, Eddie had no debt, and Primer had no debt in it. The deals we've done this year, FSG had no debt, MME had some debt, LK had 0 debt. So there's a fair spread, but the key thing around debt is how it's used and who stands surety and whether there's any upside for the seller. If someone buys 100% of your business and they put debt in, well, it's okay. They're putting the debt in, it's their business now, it's their risk. But what if it's a partial sale and they want to put debt in? How does that work and how does that become fair? And that's really what we look at when there's debt involved. Is it fair or is it skewed all in terms on the side of the buyer, effectively pushing risk onto the seller? And this flows back into this deal structure story. When deal structures are designed to push the risk back to the seller, we get very concerned. This software business is a good example. There is an element of earnout in it, but a few very positive things. One is they're getting 75% up front of a big number. So the risk-free portion is very good. But also on the earnout portion, the first measurement is now. It's the end of February. It's done. It's already in the bag. So they've got a third of their measurement is already complete. And the other incredible thing in this case about the acquirer, again, going back to the right acquirer, is any costs that they insist on incurring. So if the acquirer says, guys, you need to hit your targets, hire 4 more salespeople, the acquirer is picking up that tab. They're not bringing that into the calculation of the earnout. So you can get some fantastic deal structures, which on the face of it, you think, oh, no, we don't like earnouts and we hate earnouts. But if it's structured right, it can be very positive for the deal and enables a really positive deal to take place. So debt deal structures, it's all about getting them right and getting the right elements into it. I just want to go quickly to Justin's question. Justin, you're keeping us on our toes here. Have you ever discovered a player who's on both sides of the deal, who's conflicted, so not looking for the best deal? I've certainly picked this up with people who come to us wanting to be a client and say, I want to do this deal, but I want to stay in, I want to buy out these other guys. So I don't want to pay too much, but can you help me find the best acquirer? We probably can't, because you really do get very conflicted. And I'm pretty certain this guy's never done that deal, because you can't have people on both sides. And actually, it's the beauty of a thorough process and a process looking for the best acquirer, is you've got to be looking for the best acquirer. And the fear of having to pay too much with the best acquirer at your side is the wrong fear. The fear is having a bad acquirer at your side or a bad partner who can't deliver the growth that the business is looking for. And generally, that's another way maybe we define our acquirers. A good acquirer is prepared to pay good money for a good business because they can help deliver good growth. A bad acquirer is looking to pay the least possible for a good business because they want to effectively make their money on day one, and effectively their future profit is in the price rather than in what they're going to bring to the table.
Rick, I also think just a flip side to that is also there'll be certain, I'm not sure if it's the example you said or Justin, there are advisors as well that do both buy and sell side. And so if somebody comes and says, like, whatever your business may be, and we can represent you and we've got the buyers, it's always risky because from our perspective, I think we believe you've got to be in a single camp, because if you're not, you're marking your own homework. And I think who's in your corner and who's in the buyer's corner, we don't believe, which is why we only do sell side, that you can be both successfully, because then it's just joining the dots, an existing network back to your business versus going out there, like Rick alluded to earlier, starting with a clean canvas and going on a proper hunt and going down the rabbit hole to try and find the right buyer. So if that is the situation, we always try and warn against that because it can be risky.
Yeah, exactly. And that conflict of interest is definitely not where you want to be. Interestingly, a part of my conversation earlier was also around looking at advisors who sell to their networks rather than going to that blank piece of paper. And that's also a dangerous way to go, because I think networks only last so long. And most buyers right now, for example, Bidvest is a great acquirer. I promise you, go back a couple of years, they were the worst acquirer. And maybe by next year, things will change again. So you've got to go back to the drawing board all the time. You've got to start clean and use the freshest possible information to work out who the right acquirer is. And Andrew, just in terms of the deals that we've been doing and we've got coming down the pipeline, choice of offers, it's a cornerstone of what we're about. Any comments on that in terms of the deals that we're looking at?
No, absolutely. Look, I think when we looked at the last stats, we're still averaging 3 to 4 offers per transaction, which is really good. But I think one needs to understand that the choice is, yes, there's the price or the value of the transaction, but then it comes back to the structure, the fit. There are many elements to it. And it's really important because what I said earlier around when you embark on this journey, you, as the business owner, you're going to have a set of criteria or non-negotiables that's really important. Then there's going to be elements that are non-negotiables that are very specific to the business or your people or the transaction. And that's why you need choice, because I think one, it opens your eyes. Secondly, it calibrates value and those elements. But I think more importantly, having 4 of the or a couple of the right buyers at the table, it'll open your eyes to what the opportunity could be versus it just being a vanilla transaction. So it is so important. One of your choices always is do nothing. And we always say when you're looking at any or considering any transaction, measure it back to doing nothing. What would that trajectory look like? So it is so important because you've got to be able to compare at multiple levels. So that's why it's a cornerstone of what we do.
You're right. Just want to go into other topics. One thing I haven't done is talked a bit more about where we are as a business at the moment. We're certainly in a great year for deal closing. We've got, I think we mentioned in our intro or in the email that you got, about 360 million has closed so far this year. We've got another about 1.3 billion coming through between now and the end of May. So a lot of deal value moving. We've got a target of 5 billion in the current year of deal value. There are two big whales in there. Unfortunately, in our game, things tend to move right, not left. So it'll be tough to get them all in the current year, but they're all in the market. That's all stuff that is close, has offers, or is close to closing. So it's really exciting. It's an exciting year. One of the questions that came through was around sectors. A couple of those are in the sort of mining services sector. That's always been a good area, particularly at the moment where gold is involved. But the truth is, we had some stats that Nitish pulled for us around open cast mining across Africa is just booming, is more and more. So the businesses servicing that space there's a lot of activity and there are a lot of people trying to get into that space. So there's always room for deals in that area.
I'll pick up. Yeah, there's a couple of questions here. One is around, and thank you for all the questions. It's great. What are the key factors we're seeing right now that make a business more attractive to potential buyers? And it's, again, I suppose there are some common themes. And at a starting point, it's always about growth. Investors want to invest in a company that's going to help them grow. So that's a key thing. Rick, I don't know on your side if there's some other elements that you think, make it attractive to buyers.
I think very simply put, buyers are looking for profit and growth. You can do with less profit if you can deliver more growth. If you're not delivering a lot of top line growth, then demonstrate good margins and good profit and chase solid margins. And generally, it's a play between those things. Of course, then you can throw in project-based businesses versus annuity businesses. Obviously, annuity gets more value and will generally attract a better multiple. And just seeing Yossi's question as well, which maybe comes into a bit of that as well, where you've got businesses which run, and this is mostly the case, to be honest, in our world. We've got conservative owners, no debt, running probably excess stock. And now what do they do when the sale comes and they've got that excess stock? Their balance sheet is a bit inflated and the acquirer just wants to run a multiple of earnings. One of the ways to solve that is just to start preparing earlier about what you do with your balance sheet beforehand. So what is the right structure? Is it possible to take some stock out of that structure, put it into a separate entity perhaps, or to at least, I use the word label, your stock right from the start? So when the business is presented, when we put an IM together, we need to pick up those things so that we present the business as it really is, rather than just hoping that we solve these problems later. So I think one of the key things is to be transparent early on about how the business has been structured so it doesn't come up later and then, oh, now we're trying to scramble to pay for this excess stock. But you're right, it's a bit of an arm wrestle in there. I call it the final arm wrestle when you're working out the final balance sheet structure at the end of a deal. I think the key thing is to be aware of it in the sale process so that you can manage it and you can get covered for it, or you can get paid for it, rather than hoping it solves itself. We've certainly had deals. There was a clothing manufacturing business that we took to market. We didn't take to market, sorry. We did an evaluation of them a few years ago, and they could just never get a structure right where the kind of enterprise value calculated through why the market would look at it couldn't get past his NAV or could only equal his NAV. He's got a structural problem. He's got to fix it before he goes and tries to get the market to pay for it.
I think a really good question here as well was around why deals fall over. What are the most common reasons? And it probably also speaks back to the earlier question around what buyers look for. I think typically, one, if you're not a committed seller, I think that's one reason. Another reason is you've got to run the right process to make sure that you've got a committed buyer with proper skin in the game. But probably of the most common reasons is if your numbers aren't robust. And it's not about that you've got to run it like a listed entity. It's the ability to give comfort that there are accurate numbers that reconcile and you've got the requisite controls. So we got 2 or 3 examples now where we've worked with clients over the period of a year to get their reporting right and accurate. And what's quite incredible in all of the cases is, one, the profitability went up, but they are so due diligence ready now based on that intervention. So we can't stress that enough. It's really important that you at least the debits and credits align and there's comfort that can be given to a party objectively.
And we need to start wrapping up. Just a question from Edwin again around professional services firms are tricky, where there's a dependence on the people. I think the reality about any business, though, for the owner and the executive or the CEO is to work on the business, not in it. I think the concern is always much more around when the owner is everything in the business. That's tricky. When it's about professionals in a business, consultants, whatever, that's fine because they're going to stay in the business. But when the owners are all the professionals doing all the work and they all want to exit, you're definitely going to have more of a problem there.
Mm.
But certainly worth more conversation. And I think the key thing here for anyone listening is we're open to any conversation. We can handle the hard questions. There's normally an answer, but it's not always the simple answer that you want to hear. And getting the deal right is about the detail. It is about being aware of all of these difficult questions and how to solve them. But most of them are solvable. You know, that toothpaste business we sold the year before last, I tell you, when that guy originally told me the story about they don't own the machines, they don't own the raw materials, they don't own the product that they sell, they just run it. Can we sell this when we've got a contract? Can we sell the business? I initially said, that's going to be hard. But we worked through the detail and they did a great deal and were able to exit a business that really had nothing. So it can be done.
I've got a quick one here, just quickly on timing. It's the $1 million question. When is the right time to sell? As well as I think there was an earlier question around what happens if we engage with a business owner and we don't believe the business is ready. They speak to each other. The starting point always is understand where you are now and get a reality. And so the first phase of what we do looks at that. And part of that is assessing how do you stack up and calibrate to the market, to pricing margins, all of those elements. And what does the growth story look like? Because then that will speak to what the next steps need to be. So we've got a number of examples. In fact, we had one very recently where the business owner engaged with Rick, I think 2 years ago. And our advice was, listen, you need to focus on a specific area and go and do it. And didn't like the answer and went with another advisor and tried to approach the market. So going too early can be a real issue. Got nowhere. And then that will then speak to when you are ready, probably, you know, from when we start to pay away, you'd look, depending on the industry and how broad the search is, I don't know, Rick, 12 to 15 months, probably there or thereabout, depending on how robust the numbers are. But it takes time. And I think a big part of the time is proper prep and preparation and understanding. And then there's lots of moving parts to it. So I think that's an important part. But, you know, look, and also on the flip side, there is no perfect time. If we had that answer, it would be a very different conversation. However, there's a lot you can do around it to make sure your timing of the approach is close to the right time, because it's all about what the next chapter is going to look like.
Guys, I think it is time to wrap up. I just want, for those of you who don't know, I've got a weekly newsletter coming out tomorrow. Well, a weekly newsletter I write on a platform called Substack. So look me up. The one coming out hopefully tomorrow, well, I'm not quite ready for it, is on just the difference between a bad acquirer, an average acquirer, and a good acquirer. And I think it's really good info and very valuable in the world of just testing what's out there and understanding that all acquirers can look the same. What makes someone a good acquirer versus someone you're going to spend a lot of time with and probably never do a deal with. So good stuff there. Take a look at Substack.
Just very quickly, just link to that also. If you go to our website, subscribe to our newsletter as well, because obviously those articles will be linked there as well, and some other great insights. And please feel to reach out. But it's been a great session, and thanks so much for all the questions. They've been really good. And look, any of the others we haven't been able to answer, we'll take a look at them and hopefully get back to you if it wasn't anonymous. But outside of that, please feel free to reach out, and thanks for your time.
Thanks, Andrew. Great discussion. And any more questions, please don't hesitate to give us a shout. Cheers.
Cheers. Have a good afternoon. Bye.